The double entry system of bookkeeping. This is quite an important concept as it's the basis of what you do after you've learnt about the accounting equation. To introduce the idea to you, what I'd like to do is a Smarties activity again. For this activity, however, you won't just need your usual Smarties, but I'd like you to also make sure that you have Jelly Tots available. You'll see shortly why you need both of them. We're going to go through the same activity that we did previously. Remember that on the one side of the equation we have our assets, which in our little courier business was our vehicles that we used for delivery, the equipment, and the money in the bank. Our equity was made up of the capital that we had invested initially. Equity also increased with current income that we earned by conducting our delivery services, and equity decreased with the expenses that we incurred, for example, for advertising and our costs of running the vehicle, our diesel that we needed to put into it. The only liability that we had was the money that we borrowed in order to start the business. So, what we're going to do in this activity is every time that an account is affected, we are going to add our Smarties. But we are going to use Smarties for the assets, and we are going to use Jelly Tots to increase the equity and the liabilities. So that means that we're going to have Smarties on this side and Jelly Tots on this side. In addition to that, I'm going to give you one extra nasty little thing. When you are busy showing the effect, you are not allowed to take sweets away. So I want you to start thinking very carefully. If I'm using Smarties on this side and I'm using Jelly Tots on this side to add, how can I show a decrease? Give that a little bit of thought. Right, let's now have a look at the first transaction. We're going to decide which two accounts are affected, and then we are going to add sweets as necessary. The first transaction said the owner contributed 5 sweets to start the business. Remember that what we did over here was we had our bank and our capital affected. So last time we just added Smarties to both, but this time bank is going to get Smarties, and because capital is an equity, we are going to use Jelly Tots because it's on the other side of the equation. So that's how the first transaction is going to look. For the second transaction, bought a laptop to do business administration for 2 Smarties. For this one, remember that last time we took 2 away from bank and we added them to equipment. We can certainly put the Smarties in equipment, but what are we going to do to bank if we can't take the Smarties away? Well, we can add the 2 Smarties to equipment, but what we are going to do is instead of taking away, we are going to add 2 Jelly Tots. Remember that Jelly Tots are what is happening on the other side of the equation. So it's the opposite, it's a contra. So in this case, if we can't take the Smarties away, by putting Jelly Tots here, we are showing that bank decreased by 2. So you can see your pluses are the Smarties and the Jelly Tots are going to be your minuses for your assets. For transaction number 3, the business took out a loan of 3 Smarties and used them to buy a delivery van for the business. In this case, it's actually quite simple because our vehicles will increase by 3 Smarties and our loan will increase by 3 Jelly Tots because remember it's on the other side. So that's quite straightforward, they both increase. Number 4, paid 1 sweet for petrol. In this case, what's going to happen is your bank is going to get smaller and your vehicle expenses are going to decrease your equity. So now you need to think quite carefully. Do you remember that to decrease bank, we used a Jelly Tot? So that means we are going to want to put another Jelly Tot in bank to show that it's getting smaller. Similarly, we want to show that equity is decreasing because of this expense. So therefore, instead of using Jelly Tots, we will use a Smartie to show this. And that is why I'm going to have my sweets looking like this. A Jelly Tot in bank to show it decreasing and a Smartie in equity to show that equity is also getting smaller because of the expense. Number 5. Paid 2 sweets to advertise the courier service. This works in exactly the same way, but we're just having advertising expense instead. So we're going to add 2 Jelly Tots to bank and 2 Smarties to advertising to show that both sides are decreasing. Number 6, earned 4 Smarties from the courier service provided to clients. This is nice and easy. We can just add to both sides. We're going to get another 4 Smarties in bank because bank is getting bigger and our current income is increasing equity, and therefore we can use the Jelly Tots to show this. Lastly, number 7, paid 2 Smarties in part repayment of the loan. This is another case where our bank is going to get smaller and at the same time our loan is going to get smaller. So therefore we want to use Jelly Tots in bank to show the decrease, and we want to show Smarties in loan to show the decrease. So that's what that is going to look like. What you can do now is you can actually easily see what the overall effect is. If you look at your bank account, if all your Smarties are your pluses, you can see it's plus 9, but then minus 7 because there are 7 Jelly Tots. If you had to, for example, eat 1 Jelly Tot for every Smartie, you would hopefully easily see that you would have 2 Smarties left. That means that your bank has got 2 sweets in it. That is the balance that is left over. Similarly, you can balance your loan account and you can see the 2 Smarties will cancel out the 2 Jelly Tots, which means you only owe 1 Jelly Tot to the bank at this stage. So, what I want to show you now is keeping in mind that Sweeties activity. Your accounting equation looks like this. You have assets on the one side, equity and liabilities on the other, as we just did. Assets, we had increase with Smarties, and equity and liabilities, we increased with Jelly Tots. Let's call our Smarties debits, and let's call our Jelly Tots credits. When we had to do the reverse, notice that what we did is in our assets, we put Jelly Tots or credits. And in the equity and liabilities, to decrease it, we used Smarties or debits. So, remember that we want to create our financial statements based on the actual transactions of the business. It's very tedious to track the transactions just using the accounting equation. And so therefore what we do is we're going to create accounts within the accounting equation for vehicles, equipment, bank, capital, current income, advertising, vehicle expenses, and liabilities for the business that we've just looked at. And for each of these accounts, we will show their increase on one side and their decrease on the other side. So, the debits are going to be the left-hand side of the account and the credits are going to be shown on the right-hand side of the account. That's all that actually means. And if you keep in mind your Smarties and your Jelly Tots, you should easily be able to see how it all fits in. So the T accounts or general ledger accounts are actually going to be used to show the effect of the transactions. And the reason we call them T accounts is because they actually look like a little T with our debits on the left and our credits on the right. Or for assets, we're going to put the pluses on the left and the minuses on the right, and because it's on the other side of the equation, we're going to do the reverse for equity and liabilities. We'll show the minuses on the left and the pluses on the right. At the end of any period, you can then do a trial balance to see whether everything works out. Let's just go back a sec and have a look at this. Did you notice that for every time that you added Smarties or debits, at the same time, you were either increasing your equity with Jelly Tots or decreasing your assets with Jelly Tots? In other words, for every debit that you made, there was a credit. Similarly, for every credit that you created, there was a debit. So, if you had to add up all of your debits, hopefully you can see that they should equal all of your credits. Or if you went back to your activity, if you counted all the Smarties and all the Jelly Tots, they should have been equal, even where you cancelled them out by eating them. So this is what we call a trial balance. It's just done to check if we've made any mistakes along the way. Because there are always two accounts for every single transaction that you did, there's one debit and one credit. Both might be on the asset side, or both might be on the equity or liabilities side, or you could have one in asset and one in equity or liabilities. But there will always be one debit and one credit. It's very easy to forget one half of this by accident, or maybe to enter the wrong amount. So you can check for errors by preparing a trial balance. A trial balance simply adds all the debits and all the credits by listing every single account with its balance. The totals should then be equal. If they are not equal, it indicates that there's definitely a mistake. Keep in mind, however, that it is also possible for you to make a mistake that will not be shown by the trial balance. For example, if you entered your advertising into the vehicle expenses account by accident, your trial balance would still balance, but your expenses would be shown in the wrong place. Right, that concludes your basic debits and credits. Next lesson, we'll go on and have a look at how your incomes and expenses are affected in more detail.